we've talked about Sue on the podcast before, or someone that might have what we call the good saver tax problem, where they save too much money in those accounts. Jim and Kathy had a version of this, not as strong, but they had saved a little bit too much in those IRAs, where once their RMDs were starting, they were forced to take out more than they actually needed. So we want to structure those early withdrawals in retirement and potentially some conversions to try to level those out, right? So when we went through their plan, we looked at some Roth conversions, some tax-aware withdrawals. So if we're funding some of those early retirement goals, we want to make sure we can get the money out without a high tax friction there. We looked at some charitable strategies. For Jim and Kathy, they give money to their church, as well as a couple local nonprofits that they volunteer at and they're engaged with. So we talked about ways in retirement to give money more tax advantageously. We've talked on the podcast before about QCDs and donor advised funds. There's different ways that we can give money to make sure that it's more tax efficient. Through that tax planning in their portfolio, we were able to save them about $850,000 in federal taxation.